We have what we'll call a cautious day of trading as Wall Street waits for tomorrow's CPI data as anticipation for a potentially slowing economy grows. Our next guest says it is time to get defensive. Joining us now is Adam Hetts, the head of global multi-asset at Janus Henderson. Adam, good to have you. So with rates as high as they are, can the U.S. consumer spend enough in Q4 to not only satisfy expectations, but inspire some solid Q1 guidance, or no?
Maybe. Well, we had a great Q3 GDP print of 4.9%. I mean, that was categorically in blowout territory as per the headlines. A lot of that was driven by the consumer. And we had this summer of love, maybe, with all the Barbenheimer and Taylor Swiftonomics really driving that 4.9%. And we're tracking 2% right now. But the consumer, it really can't physically keep up that level of spending. It's starting to be a little bit overstretched. So that's part of the good that's been driving the market returns year to date in the 16% S&P. But I think there is a bad and maybe ugly counterpoint to all that good, given that the consumer, as much as it's pushed things this year, it maybe is getting a little bit overstretched.
So how does an investor position her or himself for that maybe?
Well, I think it's defensiveness. You mentioned defensiveness. We were very defensive in our model portfolios coming into this year. The dominant narrative in the market was hard landing. It was the most anticipated recession ever, supposedly. And we were with that kind of consensus narrative. But I think like the rest of the market, we've also gotten a little less defensive as market conditions have improved. But I think maybe one of the most profound themes in the market that we're going to feel through 2024 and 2025 is the long and variable lag of this historic spike in interest rates we've been feeling. If you think about it as a doomsday clock of sorts, not to get too pessimistic, but think about where we're at right now in this hiking cycle and map it to the 2004 hiking cycle that ended in 2008. You could say that today is January 2006 only, in terms of we don't know what could be ahead of us in the next year or two as far as the repercussions of all those higher rates transmitting through the economy. But it doesn't mean it's literally January 2006 and we're literally headed towards a global financial crisis. It doesn't mean investors need to be balanced. I think the risks are a bit asymmetric after we're up 16% year to date. And on margin, investors should stay invested, not move out of the market, not move to cash, even if those 5% cash rates are really enticing. Stay invested, stay balanced. But I think err on the side of being defensive through higher quality equities and very high quality investment grade fixed income.
It sure sounds like you think this tightening cycle is not different than ones we've seen that are historic, to fight inflation that we've seen throughout history, that maybe it's just taking a little longer. I'd imagine then you're not necessarily in the soft landing camp, and it raises the question, what does this defensive actually look like if you're not?
Yeah, thanks, Morgan. I think that it's unprecedented in its own way as far as the inflation that we're dealing with, as far as this post-COVID demand rebound that we're still kind of accepting and wrestling with. So what I think defensiveness means in a model portfolio, if you break down the 60-40 portfolio, within that 60, it's looking for quality in the sense that if there is some sort of a hard landing ahead, or at least some kind of economic weakness going forward because of that restrictive backdrop we're all dealing with, well, part of the problem with that could be that we're at peak earnings in U.S. equities. And in a recessionary environment, there's room for a 10 or 20% drop in earnings. So that's looking for quality in terms of wide, stable margins through those fortress-like balance sheets that can withstand the stresses on liquidity and financing going forward within the equity space. I mean, that's part of why the Magnificent Seven has driven such strong returns in the S&P this year, is they exhibit quality and strong earnings. But we can't forget about the other 493 stocks where you can find stable earnings. And unlike the Magnificent Seven, where valuations are unforgiving, there are some valuation buffers in the other 493 stocks.
Okay. Adam Hetts, thanks for joining us.